Headlines scream trade war, China's dumping US debt. The media is ablaze with dramatic stories, each headline more alarming than the last. It feels like every day a new crisis is brewing between the world's two largest economies. The tension is palpable, and the uncertainty is enough to make even seasoned investors sweat. The words trade war echo across newsrooms, social media feeds, and dinner tables, sparking heated debates and anxious speculation. But what's really going on beneath these sensational headlines? The dollar's going to crash. Or so the experts warn, their voices amplified by flashing graphics and urgent music. The idea of the US dollar losing its dominance sends shivers down the spines of global markets. People worry about their savings, their investments, and the future of the global economy. But is this panic justified, or is it just another cycle of fear and hype? It's enough to make anyone reach for the antacids. The stress of watching markets swing wildly, of hearing dire predictions about economic collapse, can take a toll on anyone. Investors, business owners, and ordinary people alike are left wondering if their financial security is at risk. The anxiety is real, and it's fueled by a constant barrage of conflicting information. We're bombarded with claims of economic Armageddon, but what's the reality behind the rhetoric? Are we truly on the brink of a financial disaster, or is there more nuance to the story? The truth is, the global economy is a complex web of relationships, and the US-China trade war is just one thread in a much larger tapestry. To understand what's really happening, we need to look past the headlines and dig into the facts. Let's unpack this, shall we? The term trade war gets thrown around a lot, but what does it actually mean? At its core, it's a series of escalating economic measures, mainly tariffs, imposed by one country on another, usually in an attempt to protect domestic industries or force a change in policy. But the consequences often ripple far beyond the original intent, affecting businesses, consumers, and economies around the world. The US and China have been locked in a trade war since 2018. What started as a dispute over trade imbalances and intellectual property quickly escalated into a tit-for-tat battle, with each side imposing tariffs on hundreds of billions of dollars worth of goods. The negotiations have been tense, with both sides digging in their heels and refusing to back down. Tariffs, those pesky taxes on imported goods, have been flying back and forth like ping-pong balls in a windstorm. Every new round of tariffs brings fresh uncertainty for businesses that rely on global supply chains. Manufacturers scramble to find new suppliers, retailers worry about rising costs, and consumers ultimately pay the price at the checkout counter. The impact is felt not just in the US and China, but across the globe. The US has slapped tariffs on hundreds of billions of dollars worth of Chinese goods, and China's retaliated in kind. This back and forth has disrupted trade flows, increased costs for businesses, and created a climate of uncertainty that makes long-term planning difficult. Companies are forced to adapt on the fly, sometimes moving production to other countries or passing costs on to consumers. But here's the kicker. Despite the bluster, China's been quietly reducing its holdings of US debt, sending tremors through the global economy. This move is subtle but significant. By holding less US debt, China is signaling its desire to reduce its financial dependence on the United States. This shift has implications for global interest rates, currency values, and the balance of economic power. It's a slow burn, not a sudden explosion, but it's got everyone wondering, is this the beginning of the end for the US dollar as the world's reserve currency? While the dollar remains dominant for now, the landscape is shifting. Other countries are exploring alternatives, and the global financial system is evolving. The outcome is far from certain, but one thing is clear. The story of the US-China trade war is still being written, and its impact will be felt for years to come. Let's talk about tariffs, those magical taxes that somehow make everything more expensive without actually raising taxes. It's a beautiful piece of political sleight of hand, really. Politicians love to talk tough about tariffs, promising they'll bring back jobs and stick it to those pesky foreigners. But here's the thing. Tariffs are essentially a tax on consumers and businesses. When the US imposes a tariff on Chinese goods, those goods become more expensive for American businesses and consumers. So, who ends up footing the bill? You guessed it, ordinary Americans, through higher prices on everything from washing machines to smartphones. And here's another inconvenient truth. Tariffs rarely achieve their intended goals. They often lead to higher prices for consumers, job losses in affected industries, and retaliation from trading partners. It's like trying to put out a fire with gasoline. It just makes things worse. Now let's talk about China and those US Treasury bonds. This is one of the most fascinating and sometimes misunderstood relationships in the world of global finance. When you hear about China holding US debt, what does that really mean? Well, in simple terms, China has invested a significant portion of its foreign currency reserves in US Treasury bonds, which are essentially IOUs issued by the US government. These bonds are considered some of the safest investments in the world, and for years, China has been one of the largest buyers. China holds a massive amount of US debt, around $760 billion worth. To put that in perspective, that's more than the GDP of many countries. This huge sum represents years of trade surpluses, where China sold goods to the US and then used the dollars it earned to buy American debt. It's a financial loop that has helped keep interest rates low in the US and provided China with a safe place to park its money. That's a lot of IOUs from Uncle Sam. Imagine lending your neighbor a few bucks, except in this case, your neighbor is the world's largest economy, and the few bucks is enough to buy a small country. This arrangement has worked for both sides for a long time. The US gets to borrow cheaply, and China gets a reliable investment. For years, China has been the biggest buyer of US debt, helping to finance America's massive budget deficits. Every time the US government spends more than it collects in taxes, it needs to borrow the difference, and China has been there, ready to buy those bonds. This has made China a key player in the US financial system, and it's given them a certain amount of leverage too. But lately, China's been quietly reducing its holdings. If you look at the data, you'll see a slow but steady decline in the amount of US debt China owns. This isn't something that's happened overnight, and it's not making headlines every day, but it's a significant shift in the global financial landscape. It's not a fire sale, mind you. They're not exactly dumping US debt on the street corner like a bunch of unwanted beanie babies. Instead, China is taking a measured, cautious approach. They're selling off their holdings gradually so as not to disrupt the market or cause panic among other investors. This slow pace helps maintain stability in the bond market and avoids drawing too much attention. It's a gradual process, but it's happening nonetheless. Month by month, year by year, China's share of US Treasury bonds is shrinking. This is a big deal because it signals a change in strategy for China, and it could have ripple effects throughout the global economy. Other countries are watching closely to see what China does next. Why the change of heart? Well, there are a few reasons. The world is changing, and so are China's priorities. They're looking at their investments and asking, is this still the best place for our money? The answer increasingly seems to be, maybe not. First, China's economy is slowing down, and they may need to sell some of their US Treasury holdings to raise cash. As growth slows, the Chinese government has to find ways to support its own economy, whether that's through stimulus spending, infrastructure projects, or simply making sure there's enough liquidity in the system. Selling some US debt gives them more flexibility at home. Second, the trade war has made China wary of being overly reliant on the US dollar. With tensions between the US and China running high, there's a risk that financial ties could be used as leverage in future disputes. By reducing their exposure to US debt, China is hedging its bets and protecting itself from potential economic fallout. And finally, they might just be diversifying their portfolio like any sensible investor should. Instead of putting all their eggs in one basket, China is spreading its investments across different assets and currencies. This could mean more investments in European bonds, gold, or even emerging markets. It's a smart move in an uncertain world, and it shows that China is thinking long-term about its financial future. So, while China's slow boat to debt reduction might not make for dramatic headlines, it's a story worth watching. The decisions China makes today could shape the global economy for years to come, affecting everything from interest rates to international trade. In the end, it's a reminder that in the world of finance, even the quietest moves can have the biggest impact. The big question on everyone's mind is, what would actually happen if China decided to go full scorched earth and dump all its US Treasury holdings at once? This scenario has been the subject of countless headlines, think pieces, and late-night debates among economists and policymakers. The idea is dramatic. China, the largest foreign holder of US government debt, suddenly unloading its massive stockpile in a single bold move. But is this really a nuclear option that could bring the US economy to its knees? Or is it more of a financial myth than a real threat? Would the US dollar collapse like a bad souffle, sinking under the weight of panic and uncertainty? Would global markets spiral into chaos? And would the world's most important currency lose its crown overnight? These are the fears that often get tossed around, but the reality is far more nuanced and frankly, less apocalyptic than it sounds. Well, it's not quite that simple. The global financial system is a lot more resilient and complicated than a single dramatic gesture might suggest. There are layers of checks, balances, and incentives that make a scorched earth move by China not just risky, but potentially self-defeating. First of all, China selling off all its US debt at once would be like shooting itself in the foot. Imagine holding a huge amount of something valuable. If you try to sell it all at once, the price plummets and you end up losing a fortune. That's exactly what would happen here. China owns over $800 billion in US Treasuries, and dumping them would instantly drive down their value, meaning China would take a massive financial hit on its own investments. Why? Because it would devalue their own holdings. The more aggressively China tries to sell, the less each bond is worth, and the more money they lose. It's a classic case of the seller hurting themselves more than the intended target. Plus, such a move would send shockwaves through China's own financial system, potentially triggering instability in their banks and investment funds that also hold US assets. It would also drive up the value of the yuan, making Chinese exports more expensive and hurting their economy. China's economic engine relies heavily on exports, and a stronger yuan would make Chinese goods pricier for buyers around the world. That could mean lost sales, factory slowdowns, and even job losses at home. In other words, the pain would be felt just as much, if not more, on China's side of the Pacific. Chinese policymakers are well aware of these risks. They know that their own economic stability is closely tied to the health of the US dollar and the global financial system. That's why, despite political tensions, China has historically been cautious and measured in its approach to managing its US debt holdings. Secondly, even if China did decide to play financial hardball, it's not like the US wouldn't have any other options. The US government and the Federal Reserve have powerful tools at their disposal to stabilize markets and reassure investors. In fact, the US has weathered major sell-offs before, and the dollar has remained the world's reserve currency through wars, recessions, and political crises. The Federal Reserve could step in and buy up US Treasury Bonds, providing a backstop for the market. This isn't just theoretical. It's something the Fed has done in the past during times of crisis, like the 2008 financial meltdown and the COVID-19 pandemic. By acting as a buyer of last resort, the Fed can help keep interest rates stable and prevent a panic. Plus, there are plenty of other investors out there who would be happy to scoop up US debt at bargain prices. Pension funds, insurance companies, and foreign governments all see US Treasuries as a safe haven, especially when prices drop. In fact, a sudden sell-off could actually attract new buyers looking for a deal, helping to stabilize the market even further. So, while the idea of China going scorched earth with its US debt holdings makes for a dramatic headline, the reality is that it's a lose-lose scenario for everyone involved. The global financial system is deeply interconnected, and actions that hurt one major player tend to ripple back and cause pain at home. In the end, stability and cooperation are in everyone's best interest. While the financial world obsesses over bond yields and currency fluctuations, ordinary Americans are feeling the pinch of the trade war in a much more tangible way: their wallets. Remember those tariffs we talked about earlier? Those higher prices on imported goods? They're starting to add up. Consumer confidence is waning as Americans grapple with the rising cost of living. The trade war has created a climate of uncertainty, making businesses hesitant to invest and hire. And when businesses are uncertain about the future, they tend to play it safe, which can stifle economic growth. So the next time you're at the store and grumbling about the price of that new TV, you can thank the trade war. For all the talk of decoupling and economic rivalry, the US and China are more interconnected than ever. They're like two awkward teenagers at a school dance. They might act tough and pretend they don't need each other, but deep down, they're both secretly hoping the other one asks them to slow dance. China needs the US as a market for its exports, and the US needs China for its cheap goods and its massive holdings of US debt. It's a symbiotic relationship, albeit a complex and sometimes fraught one. This interdependence makes a sudden catastrophic break between the two economies highly unlikely. They're stuck with each other, for better or worse. It's like a messy divorce where both sides still have to share custody of the dog.